Hi, this is Roger Conrad. I'm co-editor of MLP Profits with Elliott Gue. What I want to talk about today is some of the appreciation we've seen in our holdings. Now, of course, as an editor, the thing you want to see most when you make portfolio recommendations is rising prices, and we've certainly seen that. I think if you go and check the portfolios and see recent returns, they've been pretty robust, and particularly in the energy producers, energy producing trusts, and the trust's most leveraged energy prices that we have, but also across the board. Even the most conservative ones have done very well. The main thing I want to impart to you, though, is that you want to keep your buys at our buy targets. Again, if you do that, I think you're going to be very, very happy over time as these things continue to appreciate. I know a lot of people worry when things go up that prices may come off. If there's a sell-off, I don't think you can rule out a sell-off here. We are moving into a period where stocks tend to be fairly seasonally strong. I think there's some decent signs coming around the economy. I think the recovery is slow. I think job growth will remain tremendously slow, and that's going to definitely affect certain industries. But the kinds of things that we've been recommending, these mainly energy infrastructure, energy producing, they're really on the right track. They've weathered the downturn. Our recommendations were able to continue their construction programs, their infrastructure programs to add more cash generating assets. They were able to do that last year. Now they're able to raise capital. They're able to not only issue units at the highest prices that we've seen in many months, but also to issue more debt at very, very low interest rates. In fact, in some cases, we're seeing companies come out with long-term notes at spreads to treasuries as low as 200 basis points. So again, this is tremendously bullish. These companies are taking advantage of a very nice environment for raising capital, and the cheaper they can raise capital, the more projects become profitable for them to undertake, and the more their cash flow goes up, and the more dividend increases we've seen. And we continue to see steady dividend increases for all these things. So we're not overly worried about the price run-ups. Again, we do advise that investors buy below our recommended buy targets. On the other hand, also take a look at the how they rate table, and you'll see more than a third of the companies covered there, and we cover every master limited partnership traded in the United States. But about roughly a third of the companies covered there are rate sells right now. Some of that's because of the businesses they're in that just aren't suited to being in a limited partnership format where they pay out so much income and so much of their cash flow in dividends on a regular basis. Some of them are there because they're financial constructs. Definitely in the crosshairs of the Obama administration, which is looking for tax revenue wherever it can. And some of these are very popular entities like AllianceBernstein. But the ones that we have in the portfolios, again, are not affected. They don't have carried interest, so they're not coming under this new scrutiny. And again, they're growing on a very, very steady course. One I'd like to bring to your attention would be Energy Transfer Partners. This is one that we have in our growth holdings. And this portion of the portfolio is sort of a hybrid between the conservatives, which are basically centered around assets, very, very steady revenues, and then the aggressives, which are centered around energy production. So again, more volatile. The growth have some exposure to changing energy prices, but are mainly based around fee-generating assets. And that's the case for Energy Transfer Partners, which continues to embark on a number of very strong projects which will add to revenue going forward through 2011. It still yields well over 8%, which is a bit higher than some of the other recommendations we have, which have run up, so that's attractive. They've also settled a long-standing dispute with the Federal Energy Regulatory Commission that dated back to alleged improprieties back during the aftermath of Hurricane Rita on their pipeline system. FERC originally wanted something on the order of $152 million in fines and so forth from Energy Transfer. But as the case has played out, that number has progressively been reduced. FERC was actually defeated in court on the issue, and now Energy Transfer has settled it for an outlay of about $5 million. So that's a very, very bullish thing. I think has yet to show up in the share price, or the unit price rather. But again, making that one a particularly attractive one at this point in time. So please check out the portfolios. We have a new article every week. There'll be a new one this week, and on a more general basis. But we try to keep you up to date, and the how they rate table again provides coverage of all the various companies. So that's all I have for today, and thanks for tuning in. I'll look forward to chatting with you next time.